From Barangaroo Studios, this is the COB, brought to you by eToro. Invest in ASX shares with $0 commission.
Hello, this is the COB, all the stuff you need to know about the day and perhaps even the week in business. It's a short week. I'm Kyle Rotto and with, of course, Danielle Ekuye. Danielle, what can we say about today's trade? There really wasn't much to it, was there?
No, not a lot. I mean, it really went risk off after the RBA came out about their financial stability report. So I think there's a few people taking some risk off up until, we go into Friday's jobs report in the US. Nobody really wants to be long anything at the moment where they feel there might be some bad news lurking. But I think volumes are really, really low at the moment, Kyle, and that is typical of the day before a long weekend, before a holiday. Low volumes, prices tend to move more. It's a wait and see game at the moment.
It certainly is, yeah. We're not going to be back on board until Tuesday. So with all the potential goings on Friday night and going into Monday as well, there's a lot of risks that you're attempting to react to on Tuesday morning if you're holding something into the long weekend. But let's get to the three themes of the day, because I think that takes us to the point we're making here. And actually, I thought it'd be interesting to start with what we got last night out of the United States, which was some weak economic data. And I have to say, I nixed this from Bloomberg, but it's the question perhaps we're asking now, is bad news just bad news? We're used to bad news meaning potential rate cuts, and equities benefit from that. But some soft numbers out of the United States, the ISM Services PMI, as well as the ADP private sector jobs numbers in America, both weaker than expected and perhaps pointing to a bit of a downturn, and that didn't seem to be treated too well by investors.
No, absolutely not. So the thing the market has been overlooking, it's basically been saying, Kyle, that it doesn't matter if the economy slows down because interest rates will come down. So we're happy to buy big tech. We're happy to buy selectively. But at the end of the day, if the economy slows down, you are going to have those earnings downgrades, and we are going into the US reporting season. And I think this could be a real confessional time for US companies, because they really have to lay their cards out on the table now. The Americans are very good at massaging is the wrong word, but setting expectations for their earnings. And if they're seeing signs of a slowdown, then I think there might be some disappointment. So we are in a bad news is a bad news cycle.
Yeah, there's a reason why 72% of companies generally beat expectations on S&P 500. They set that bar low, and if that low bar isn't exceeded, then of course it's going to come with a bit of a backlash in markets. Now, just in terms of the other three themes for the day, we spoke about it before, the risk-off element in the market. Very, very eloquently put by yourself before. Quite naturally, just the whole notion of not taking any risk, no long positions into the Fed onto the non-farm payrolls on Friday night, and those non-farm payrolls in particular, expecting flat, the unemployment rate to remain more or less steady, but jobs growth to slow down, and we'll be looking at that wage growth figure as well, expected to come in at about 0.3% average hourly earnings, which, as we know, we'll all be watching for because of, the potential that there could still be some stubborn inflationary pressures persisting in the US.
Absolutely. And the thing about, unemployment, it's very much a lagging indicator. And I think sometimes you can question whether or not the Fed is really focusing too much on inflation. But it is very important that wages growth doesn't start to embed itself too much into the economy, because then you get inflationary expectations coming up. But what I think is really interesting, I'm watching our Australian dollar, and you can tell how much we're in a risk-off scenario, because we are very much a resources country, a housing-related property country, and the Aussie dollar's under 67 cents at the moment. So definitely, traders again taking the risk off as they go into the weekend.
Yeah, and that's you noted on the desk today too, despite what hasn't necessarily been a resurgent US dollar, it's a little bit stronger than where it was a few months ago, but we're not seeing the greenback absolutely shooting the lights out. So this seems to be a bit of an Aussie dollar story, and we did see obviously trade balance data out today as well.
Yes.
Trade surplus increasing, but hold on, because of weaker domestic demand. So a little bit of a
lower
caveat
imports, basically, lower imports, and also a slight fall in terms of people travelling overseas. So maybe interest rates are finally starting to bite here at home and people are starting to tighten the purse strings. And for those of you that are travelling, it won't be an unwelcome thing to watch airfares come down.
I can tell you that that's certainly been the case over the last few months. So taking some pressure off, well, my relationship as well as my bank balances, I've got to say. But let's get to some of the sectors of the day. And well, it's been very, very defensive actually. Just you, I think, might have a couple of them on your screen.
Yeah, I've got some great little stats sitting here. So really, I thought it's worth just focusing on the fact that real estate, the REITs, have been very heavily hit over the last month. So I'm looking at about a 17% decline over the last month and about 1.4% today. And if we contrast that in what's going on in healthcare, everybody's racing into healthcare. Defensive stocks, we spoke about that yesterday with Mark from Macro. CSL is back up knocking at that $300 level again, and people are very, very positive on it. So again, selling off in energy, materials, also consumer discretionary stocks down about 1.3% today, and the consumer staples, the likes of Woolworths and Coles, a bit firmer, as well as the utilities. So the Australian market is really, really positioning itself at the moment, not unlike the US, in terms of let's be defensive. If we have to stay invested, we want to be in the stocks that hopefully will outperform.
Absolutely, and just to add a little bit of a garnish, because I couldn't do it any better, of course, it was literally just the textbook defensive positioning. For some numbers for you, utilities 1.06% higher, healthcare just over 1.5% higher, consumer staples 0.35% higher. So there you have it, investors looking for some comfort in those defensive names. But just in terms, I suppose, of some of the big stories of the day, I guess the corporate news flow has been a little lighter. Some M&A activity this week has obviously caught the attention, but otherwise today a little bit quieter. But BHP in the headlines, announced a program to support promising minerals explorers, and it will expand beyond copper and nickel to prospective uranium and lithium projects from September.
Oh, that's interesting. Lithium.
Interesting.
They're going into lithium because BHP always said the lithium market wasn't large enough for them. They only wanted to go into, very large secular growth. And I do think uranium as well. We've been discussing uranium throughout the week, and it does seem to be as though there's much more of a push now at looking at nuclear baseload power.
Absolutely, a sign of the times potentially. And in fact, Bank of America Global Research on the topic of lithium has lowered the earnings estimates for lithium stocks, of course, in the short term after cutting the price target recently. It downgraded Albemarle Corp to underperform from neutral, and that did have a little bit of an effect on the broader lithium space after that big news of the potential acquisition and the rejected bid by Liontown Resources of Albemarle, about $2.50 per share, I think it was. We have seen throughout the week lithium losing a little bit of steam, of course, much higher than what it was a couple of weeks ago, nevertheless. But, that takes us to, I guess, a bit of a discussion around the stock of the day. And, I'll see if I can actually get that in my ear potentially, because I missed the call. I have to say I was running around Sydney trying to hand back keys to one apartment, pick up keys to another, just another victim here of the rental crisis. But it was Rio Tinto. Have a listen to what our guest had to say about the investment case for Rio Tinto.
My only thing with Rio, I tend to agree with that analysis, and I think Rio will be a better company in a year or two with that added diversification. However, I'm very wary of buying cyclicals at the top of ranges into.
Probably a little bit more bearish on iron ore prices as well, mainly from a supply side point of view. So that's probably, you can tell what our opinions on Rio would be just from that statement. Yeah. But the blessing and the curse of Rio Tinto is that it's such a large and complex business. And to give management credit, probably the last 12 months, they're actually starting to hit a bit of a purple patch, particularly as they improve efficiency in the shipments. So they had a big bottleneck issue in their shipments in iron ore, but it's just not the right point in the cycle. So I think this is one that you should actually pay a bit closer attention to. Last 5-10 years, they've really struggled to maintain even the midpoint of their shipments guidance, which has been the reason why everyone says you'd always just buy BHP. But that narrative might be changing over the next 12 months, particularly depending on how their Pilbara division goes. So something to watch there, but not the right point in the cycle for us. We'd probably be happy to take some profits and sell.
Okay, so that was Mark Gardner from Macro Capital and Daniel Ortizi from Stock Doctor / Lincoln Indicators talking about the investment case for Rio Tinto. But Danielle, obviously I wanted to ask you a little bit just on that. I mean, are you exposed to the mining space or any of the big miners in particular? Because it seems to me that people have sort of, I guess, gone for the BHPs of the world over the Rio Tintos, perhaps even Rio Tinto trading at a bit of a discount to BHP. I mean, what's your view on the space?
Well, just speaking personally, I like the diversification that BHP has, and I wouldn't be totally comfortable about having greater exposure just to iron ore. I think the fact that BHP is very clearly trying to transition to the new secular growth themes within the clean energy space, or diversifying away from the fossil fuels, because I do apply, albeit my own personal ESG filters, and it's worth stating that because a lot of ESG can be quite, personal and judgmental. But for me, I just don't want necessarily pure exposures just to China. And I think when we're looking at Australia and also the big tech companies over in the US, I think increasingly we need to look at them through the filter of the China-America geopolitical risk. So BHP, diversification in this case is what works for me, but that's only me.
Yeah, absolutely. And those ESG filters can be very subjective. You're talking to a vegan here. So I own about 4 stocks and they're all about tech. So that's how tight I run those things for me. But anyway, let's go on to just really quickly, just the view that you wrote today. Yeah. Of course, it's going to be in the Close of Business newsletter sent to your inboxes. But a bit of an interesting discussion, especially, I suppose, revolving a little bit around property once again, the big talking point for this week.
Absolutely. So there's some interesting figures that have come out of the US, and we know that US residential prices have been falling. And we also know that there's a lot of focus on what's happening with commercial property over there. You've had some redemptions in some of the closed-end funds for Blackstone, and investors are basically pulling back. So these are quite, it's not about being bearish, but we have to look at the facts. And US regional banks now have about 60% exposure to the US $2.9 trillion commercial property market. So Tony, our guest in the former segment, was actually talking about the fact that regional banks are under increasing pressure because they're losing deposits on one side. On the other side of the coin, they've got this huge exposure to commercial property. But what's happening from the investor space is the latest sales of US rental apartment buildings, they're actually declining at the fastest rate since the GFC. So according to CoStar Group, US investors bought $14 billion worth of apartment buildings, which was down 74% from the same period a year ago. And that compares to a 77% decline in 2009. So I guess it's not about being necessarily bearish, but I think when Jamie Dimon came out and made the point that the banking crisis isn't over, my piece today focuses on another gentleman out of the UK, Ian Hartnett, who runs Absolute Strategy Research. He is a very interesting person to follow, and he just highlights that there is ongoing systemic risk, he feels, and it's all about, we had low interest rates, 0 interest rates for such a long time, that encourages a lot of borrowings. By definition, property is a highly leveraged asset. It's one of the reasons why Australians love it, because they can make money out of it because it's leveraged. Of course, when interest rates are coming down, everything's fine, but when we've had the steepest rate rises in 40 years, when the tide goes out, we see who's swimming naked. And I think it really is as simple as that. It's not a hard concept to get your head around. And for investors, it's always about risk management.
Absolutely, and I feel like it's a subject of conversation we'll pick up again throughout the year as liquidity conditions tighten. But let's move on and get to our guest, final guest for the day, final guest for the week. Henry Jennings from Markets Today joins us now. Henry, I wouldn't mind actually getting your view, just because if nothing else, it's the buzz topic for the week, the risks in the property sector, the commercial property sector in particular. Even the RBA today in its financial stability report alluding somewhat to the risks in property. I mean, is this something that you keep much notice of? It plays into perhaps your estimations of the world. How do you interpret what's going on there potentially, especially as it applies to the local market?
Geez, Kyle, that's a question and a half just before Easter. I've got to say, I'm not a commercial property expert by any stretch of the imagination. When you look at the REITs, the big valuation uplifts have always come from revaluing the properties, of course, and that's why they've been so attractive. Interest rates are falling. The bond market yields have absolutely collapsed. And yet the REITs have been under serious pressure, as Danielle says. Welcome, Danielle. It's our first time, so that's exciting. But I got to say, commercial property is not my area of expertise. And it's always good to have a curly question before Easter, Kyle, so thanks for that.
Well,
I appreciate it.
Hey, Henry, our first time.
Hi.
I don't know how we're going to interpret that, but hey ho, let's go.
Yep.
Lithium.
Hey,
Let's
Yep.
get on to lithium because I did pick up today from the China Caixin survey that actually car sales have been quite weak over there. So how are you looking at the lithium space? It was a very crowded trade. Clearly the money is coming out. We're getting downgrades. How do you see it?
I see it as a fantastic opportunity at some stage, Danielle. I've got to say, 2022 was the year that lithium went nuts, and as always, things overshoot. You've got to remember the lithium price that we see is also very thin. It's based on not an awful lot. It's not the most transparent market. There's many different products in the lithium space, some doing better than others. Lithium carbonate not doing so well, but lithium hydroxide doing slightly better. But this to me is an opportunity, a long-term opportunity. There's no doubt, let's face it, that the long-term electrification of the transport sector is happening. Maybe 1 month it's a little bit weaker, 1 month it's a little bit stronger. But at the moment, we're certainly seeing the lithium price under pressure. We're seeing that Albemarle downgrade by Bank of America. I mean, come on, guys, where have you been? Have you been asleep at the wheel? I mean, the lithium price has crashed and now you're downgrading? I mean, really and truly, you've got to be crazy. And yet, Albemarle are confident enough in the future to lob a big bid at Liontown. $5.6 billion bid at Liontown, which is still not even producing, it is constructing a lithium project. So clearly that the industry players themselves and the car manufacturers are out there, they are looking to get their hands on long-term supply. Now, the prices of lithium could never last at those ridiculous levels, let's face it. But there is an opportunity brewing still. I think we're still a little bit early. If I was someone that looked at YouTube a lot during the day and was Googling commercial property values, which I'm obviously going to do now, Kyle, in light of your curly question, then I would suggest that maybe, I'm not a conspiracy theory kind of person, but, you'd have to look at the lithium price and say, there's something funny going on here. There was a big ramp up, there was a big collapse, everybody's talking it down, the Chinese talking it down, and they have the most to gain from lower prices because they are the market for electric vehicles at the moment. And Europe's backing off a little bit, but I think there is an opportunity, especially in the likes of Pilbara, which is producing. And I think, if you look at 5.6 billion for Liontown, and then you look at the relative valuation for Pilbara doesn't look expensive with $2 billion odd in cash as well. It's only probably $8.5 billion market cap now. So anyway.
Takes me to my next question, Henry. Quantum mechanics, no, obviously joking, but...
I'll go to the Canadian Prime Minister for that. He's my phone a friend as far as quantum mechanics go. I can talk quantum computing if you like, Carl.
We might have to pick up on that one day, but with obviously a little bit more forewarning. But just in terms of the data coming up in the next couple of days in the States, it comes on a public holiday, no less. And the sort of the narrative that came out in the last 24 hours, at least going around the financial media, is, bad news is bad news again, referencing the PMI surveys of the last couple of days and the other jobs report that we had. Do you get the sense that the markets are starting to kind of become recession sensitive, where, okay, we might get rate cuts, but hang on a second, that means there's going to be a big hit to growth and probably earnings as well?
Yeah, interestingly, I did pick up on something that the RBA governor was talking about yesterday, Phil Lowe, at his press club thing, talking about margin expansion, which to me signalled gouging. There's a lot of focus on margins. There's going to be a lot of focus in US reporting season on margins and whether they're under pressure or not. I suspect, here we are with 3.6% unemployment in the US, and we have been predicting this recession for so long now. I mean, eventually the analysts and the economists are going to be right, aren't they? Let's face it, there will be a recession in the US at some stage. But at the moment, there doesn't seem to be much sign of it. The jobs market's holding up pretty well. GDP's holding up pretty well. Company profits haven't exactly cratered. In fact, the stock market, the Nasdaq was officially in a bull market, up 20%, and the Dow and the S&P are all positive for the year. So, and we've gone through a banking crisis. And of course, there's commercial property to bear in mind as well. So, there's a lot of things at play here, Kyle. But, by Tuesday, we'll probably have forgotten about the non-farm payrolls and be focusing on the next big thing to come out of the US. But, as long as it's within a kind of reasonable range, I think the market will just do what the market wants and prepare itself for US reporting season. And, of course, us for the budget come May.
Yeah. So, Henry, are you sort of positioning more in defensive stocks at the moment, or you're just literally, no, you're just staying with the stocks that you like, basically?
I don't do defensive, Danielle, really and truly. Defensive is cash. I run a small cap portfolio, and that, by virtue of what it is not defensive. There are a few defensive stocks that I could name that I've got in there, which are usually some sort of corporate deal involved, which does give a sort of quasi-cash appeal to them, but certainly not looking at the healthcare sector particularly, certainly not looking at the REITs. They really don't fall into my purvey of stocks in the small cap sector. More interested in commercial property, to be quite honest.
What about gold?
What about gold? The gold, I always find it funny that the US commentators on CNBC, sorry to mention a rival channel, but the US commentators on CNBC are a massively great indicator of tops. They got really excited about lithium, and as usual, the Americans are late to the party. They got really excited about lithium last year and were spouting on about it, and then the lithium price crashed and has been crashing. Now they're all getting excited about gold. Here we are at 2,000 US an ounce and 3,008, I think it is, in Aussie dollar terms. So it's pretty good out there for gold companies. They could do some serious hedging at the moment if they want. But, I think gold is going to simmer around these kind of levels. We've seen the odd day when it really does pick up. But I think, with gold shares, you do have to buy and sell them. They're not numbers on doors. It's good to sell into strength. And at some stage, the bullion price will fall over again. It'll drop $40 and everyone will panic, and then it's the time to pick them back up again. So you need to trade gold stocks. I think we're tending towards the top end, maybe the last sort of 5-10% in gold for the time being, and then a little bit of a consolidation phase.
So maybe the inverse Kramer ETF there for you potentially. Just last but not least, putting kind of, I suppose, all of that into a bit of a bow, so to speak. I mean, you made an allusion before that, if you're defensive, you're in cash, and we'll probably find another narrative to explain why the world's ending next week. Is this to say that where you are right now, you're pretty confident to be invested and might be even putting some new money to work in this market as well?
Yeah, I got to say, I think April is going to be a good month for the market. Traditionally, it is a good month for the market. Now, I'm not just sure how it fares after May. I've got a feeling we could be in for a sell in May and go away. And I also think that with June coming in the tax loss period, that may cause some trickiness, especially in the lithium space. You may be able to pick up some incredible bargains in June as people just tip out stocks in the resource space that just have been walloped to this year. So I think June could be a pretty good time there. We do have a federal budget in May. There's lots of question marks about resources in there with the petroleum rent resource tax changes there. Of course, the new emissions schemes that are coming in, so that has implications for Woodside and Santos, etc. So I think April good, May not so, and June could be a great opportunity.
Henry, really appreciate you coming on and tolerating my curly questions, of course. Have a wonderful long weekend. Henry Jennings from Marcus Today.
Thanks, Henry.
Thanks, Guy. Nice to see you, Danielle.
Okay, well, let's move on, of course, and let's have a look at what's happening tonight, because we have been speaking extensively about the US non-farm payrolls numbers, but we do get a little bit of jobs data out of Canada. The US unemployment claims, always a good, sort of more forward-looking indicator, I guess you could say, on what's happening in terms of hiring in the United States, or really actually firing. But let's have a look now also at what's going on tomorrow, because public holidays right around the globe, but as we've been alluding to, Danielle, just that US non-farm payrolls data to cap off the week.
Yeah, and just having a look here at the US futures, they're all being marked down at the moment. I wouldn't think you're going to get much happening in the US either in the run-up to those employment numbers coming out on Friday. So, you know, everybody will sit on their hands and then panic on Monday, I guess, or not panic as the case may be. But I'm a little bit more hesitant than Henry about this April being the great month, but we're going to have to wait and see, aren't we? That's the thing about markets.
Two sides to every trade. Okay, well, let's take a look at the leaders now of the day. And while we have been talking a lot about a bit of a defensive skew potentially, there's no kind of theme that jumps off the screen at me right now. Maybe even you could say as well, some moves could be exaggerated by the fact that, you know, volumes are a little bit lighter, liquidity can be a little bit thinner. But Imugene up the top of the table there, 7.4%. Anything that jumps out to you potentially, Danielle? Maybe the ones that you might have in your portfolio?
Yeah. Oh, I can't go revealing all of that.
No, magician never reveals their secrets.
Exactly. No, I think the ASX might have had some good numbers, some good monthly figures there. And obviously the whole chess imbroglio and blockchain has really been sitting on that share price for quite a while. So they might have had some better than expected monthly figures there. Silver, Henry's absolutely right. CNBC has been talking a lot about gold, but they've also been talking about silver. So maybe that's why we're seeing Silver Lake Resources again in one of the winners. Bega, not so sure, might be a special situation. And I definitely think, though, that the lower volumes during the day would be tending to accentuate some of these price moves that are going on, unless you found something why.
Yeah, well, I certainly not getting a boost to its profits from my consumption of Bega cheese, but apparently analysts at Bell Potter retain their buy rating on the company and improve the price target. So maybe something behind that. Lift there. Might be a bit of a lift, yeah, exactly. So we have seen actually a lot of broker upgrades coming throughout the week, and actually moving prices. We were talking about that today with a few guests about Seek in particular, which has actually performed reasonably well. Gary Glover, in fact, I was talking about that with Seek. So let's look at the laggards now as well. And well, nickel mines. Actually did have a conversation today about the nickel price. Yeah, really interesting. I mean, one of those commodities I feel that often gets overlooked in the conversation locally because, well, you know, you've got the sexy ones now in terms of your lithium, and you might be in your uranium, and then the old stalwarts of iron ore, and everyone loves a little bit of gold here and there. Nickel's market dynamics are fascinating, especially with what happens in Indonesia and what have you, but prices have been trending lower recently, and I'm not sure exactly why that necessarily is the case, but nevertheless, nickel mines off by 6.11% today, your worst performer. Inghams, well, people are eating cheese, maybe not chicken, down 5%.
Yeah, I think there is bird flu again in Japan. I read that this morning. So in the absence of finding anything else, yeah, I'm just having a look here that there seems to be a high mortality rate among batches of chooks supplied by Inghams, the meat growers. So, yeah, difficult one. Commodity sort of stocks, soft commodities, always quite challenging. What is it they say? You don't make movies with animals and children. could be a little bit the same.
Same with your
stocks.
investing. Well,
Yeah.
Definitely with investing. Don't invest in anything that uses children anywhere along the supply chain. I have to say that
Barring
much.
that, but just animals in general.
No animals or children when you invest. That's Danielle's ESG filter right there. So okay, no animals, no children. I'm all right with it. But there we go. There are your laggards for the day. And here are the small caps. Actually, Eleanor investors
have bought the property portfolio from Challenger, I think, for
there
about
you
$40
go.
million, $41.8 million there.
Spot on. And Inghams Healthcare, this is where we start testing our knowledge of the depth in the market here. But obviously big moves as always. Let's look at the laggards though in terms of the small cap. Energy Resources. Oh, hang on a second. I suppose it's a 6-cent share. So what's that? Maybe a 2-cent drop for Energy Resources. Let's see if we can get you some news there, because if you weren't across it and you just saw it on your screen, well, you might be just having a conniption right now. But Energy Resources stock, let's have a look. Well, Magellan actually is still falling today. Not down there on obviously the small cap list, but that's still moving lower. The uranium's development shares came under significant pressure this week after it announced, it's trying to raise capital. So there you go. And it's raising it at a discount. So that's contributing to that weakness. In fact, that news came from earlier in the week. Let's move on, shall we? So there's your small cap moves. I felt very much inclined to try and get that Energy Resources news to you, because that is a fairly big drop. But lo and behold, final day of the trading week, we have given up 0.31%, Danielle.
Yeah.
And actually, I think for the 4 days, we might be, if not slightly higher, more or less flat. So you're kind of a bit neutral, really.
We've really been tracking around that 7,200 level once we came through it on the ASX 200. And just looking at the ASX 200, it actually came off its lows. It was off about 0.5% at one stage and closed down about 0.25%. So really I think markets are looking for a lead, and they are tracking sideways. There's lots of rotation going on, and we'll have to wait till next Tuesday, next Monday, if you're that interested, when the US markets are open on Monday night our time.
Yeah, absolutely. And we'll see you on Tuesday morning, of course, when we are back online. But in the meantime, I hope it's been a wonderful trading week for you. Remember, you can catch up on all the news and views on our website and app. Well, until Tuesday morning, have a fantastic long weekend.
Have a great weekend.
The COB is brought to you by eToro. Invest in ASX shares with $0 commission.